Hey, welcome. Grant Cardone here, and you are with me on this beautiful Monday in Miami where it's 70 degrees. It's so beautiful here. Maryland, beautiful Maryland behind me on our wall here. We're talking real estate on Mondays. As you know, I'm going to show you how to get in the real estate game and why you want to get in the real estate game. You're working hard every day to earn money. Most of you out there are saving money. The problem most people have is they don't get their money to work for them long term. So I'm going to show you today in today's show how to earn 8%. Hey, I need somebody, guys, to help me on this angle here because it's not quite right. I've been out of the country, as you know. We were in London, Dubai. Where else were we, Johnny? London, Dubai, Abu Dhabi, Dublin, and back to Miami. And we were looking at real estate in all those regions. Ladies and gentlemen, real estate in America. I know you think it's expensive. You're wrong. Sorry to tell you this. I'm your friend, I'm your buddy, I'm your uncle, and mostly I'm your guy that'll help you with real estate. American real estate, particularly the multi-family apartment complexes like this that we're buying right now, 531 units in Maryland, beautiful Maryland, Columbia Town Center, 2 blocks from a Whole Foods. The rents are $1,800 a month here. We think those rents can go $200 higher based on what we already bought without any improvements in the property. We'll close on that this month. It's open at CardoneCapital.com, CardoneCapital.com. The best real estate investment vehicle in the world today, allowing everyday investors to partner with me and get access to deals that you could never buy yourself. These deals were never available to the everyday person until now, until Cardone Capital made them available to both accredited and non-accredited investors, where you get to earn 7 and 8% on your money cash flow out of this deal, 7 to 8% cash flow while you wait for a 15% internal rate of return due to appreciation. I'm going to actually show you how to increase that. But what I want to show you today, whether you invest with me at Cardone Capital or you want to go out and buy your own deals, a lot of people seem to think that they got to go buy their own deals because they're like, I want to be the man. I got to be the man. I got to be the landlord. And you never end up being a landlord. You end up being a manager handling 8 units. Your target should be 8 to 10%, okay? Either cash flow or internal rate of return. The deal behind me that they're throwing on the screen, messing up right now, actually we think will do 15 to 18%. 15 to 18% cash flow and appreciation. Thanks for messing that up, Francisco. You're awesome. Our number here is 305-865-8668, 305-865-8668. Please rag on Francisco, who's messing up my images in the background. I'm going to show you how to do this, okay? Let's say you live, and you can call in if you got a deal or you got a question, call in. Let's say you got a deal that's $1 million, okay? I'm going to take $1 million deal because that'll buy you, in most markets, it'll buy you about 10 units. Could buy 20 units, okay? Could buy you 20 units at 50 grand if you're in the Midwest somewhere. I did Vlad's show, Vlad TV, and I said nobody should be investing in places where there's snow on the ground. I got all these people ragging on me. Who are you to tell people they shouldn't be investing where there's snow? Look, where there's snow, you shouldn't go. Okay, if you're getting hammered with snow, is this snowing today in Columbia? In Maryland? Probably is, probably is. Look, when I say that, folks, what I'm saying is that if you got 4 months of snow on the ground, okay, if you're in the Midwest, if you're in Denver this weekend and you got hammered, yeah, that's a great market to be in. I don't mind being in a little bit of snow. But you got to be careful when you're in these markets in the Midwest where jobs are leaving mostly because of jobs, and number 2, because of weather. People are leaving. As the population in America continues to age, it will move south. Okay? I mean, Phoenix wouldn't be Phoenix if it wasn't for old people moving down there with lung problems. Let's keep it real. So look, $1 million deal is going to be 10 to 20 units. I write about this in this book. 16 units is your minimum deal. I'm just telling you, your minimum deal. You can get this book free at my website, CardoneCapital.com/book. It's free. If you can't pay for the shipping, you won't buy any real estate. Okay, $1 million worth of real estate, $1 million worth of real estate, it'll be about 10 units, maybe 20 units if you're at $50,000 a door. Okay, if you could find these deals in your market, let me know. My target for you is 32 units and $3.2 million. If you're looking at these deals, exactly what I say in How to Create Wealth Investing in Real Estate, what you're looking for is an 8 to 10% cash flow. That's a good cash flow. As you go lower, by the way, and I say this in the book, as you go lower, you get better property. Now, the property I'm going to show you today, we think, come on guys, quit moving it back and forth, just leave it alone. We think the property that I'm going to show you today that we just made available to our investors is going to return a 7 to 8%. But you see, Johnny, when you come on this side, let me show you something. See what I see? It's a little distracting because I get cut off. Here's your target, okay? $3.2 million, perfect. $3.2 million is your target. That requires about 800 grand down. Now, before you're like, oh, Grant, you don't understand, I don't have 800 grand. Okay, good, that's fine. I can show you how to do this with less than 800 grand. You can either drop the size, okay, $1 million, you're gonna need about 250 grand. Well, I don't have 250 grand. Okay, well, good. If you're gonna go below that number, then you just need to invest with somebody like me. That's why we open Cardone Capital, okay? Either way, whether you're doing, you can't solve this problem. If you can't solve that problem, you're not gonna be able to solve the problem of managing a deal and making money out of it, okay? So if you're buying a deal for $1 million, you're gonna put about $250,000 down. You're gonna finance $750,000. You're going to finance $750,000, okay? The $750,000 is going to cost you, if you use your rate factor that I share with you in the book, $750,000. At some point, you're going to have to get an education how to do this. Otherwise, you're never going to do it. This is going to cost you about $46,000 a year. Okay, your NOI on this deal, the NOI on a $1 million deal, if it's a 6% cap rate, that's going to earn $60,000 a year. Okay, I would love an NOI of 6%. I don't think you're going to find that today in the marketplace. If you found that, you'd have to ask yourself what's wrong with the property. 6% cap rate on $1 million deal would produce $60,000 of NOI. $46,000 is going to be your principal and interest. You're going to make $14,000 to manage 10 units. And you're going to be carrying a gun with you to go collect the rents. I'm not kidding about that. You probably will be, okay? $14,000, if I divide that by 14,000, 14,000. If you had good credit, divide about 250,000. If you had the 250,000, that's gonna pay you 5.6% a year. Now you're like, yeah, but what about that 8% you talked about? Because you're gonna probably be paying your principal down by about 2%, 1.5% to 2% per year. Your debt's gonna be going down. This $750,000 is gonna be reduced in 10 years by about $140,000, okay? That is a return on your investment and should be considered cash flow. Now I'm gonna show you our little deal here. I'm gonna show you how to do this, where you don't manage it, don't have to take phone calls, don't have to rent it, don't have to find it, don't have to buy it, don't have to negotiate, don't have to handle tenants, don't have to look at lease applications, don't have to evict people, because all that's going to happen. We're going to buy 531 units in Maryland, 2 blocks, less than 2 blocks from a Whole Foods. Okay, literally people are walking down the street. Can you show them the image of this, Johnny, without them seeing my board? Just the whole screen. Okay, beautiful property, okay? We've already have this under contract. I'm closing on it this month with my money. How confident am I? My numbers here. I don't know if you show this, Francisco, if you show this sheet right here. I'm a little scared about you showing this though. Yeah, don't do it. Don't do it. You know, Venezuelans. Okay, so $133 million. Let me see what I'm going to be all at in this deal. Actually, I'm going to be more than 133. I'm going to be $140 million. I'm going to be about 140 million. I'm rounding up right here. And you're like, wait a minute, dude. You just went from $1 million to $140 million. That's right, $140 million. I am financing 99 million. Okay? I am going to put down $141 million of my own money to buy this deal. Okay, I'm just going to tell you how I look at a deal. On this deal, I would be happy to earn $22.4 million a year. 6%, I would be tickled to death. 5%, I would be actually happy to earn on this deal. However, on this deal, I think I'm going to earn almost 8% because my cash flow on this deal, my cash flow right here, 305-865-8668. Johnny, do I have callers? Oh, phones aren't working, so don't call. Okay, cash flow. Where's my cash flow in this deal? My NOI on this deal is, how long have the phone's not been working?
We just got it here today.
Okay, yeah, 6.8. 6.8 million is my NOI. Okay, so if I divide the 6.8 into the 140 million, I got a 4.8. Very difficult to find these deals, particularly in that market. This is a 4.8 cap rate on actual, meaning trailing three income, trailing 12 expenses. Like, you guys are following me on this YouTube channel, you got to subscribe to this channel. The information I'm giving you here for free is freaking stupid. Trailing 3, trailing 12. Trailing 3 income, trailing 12 expenses, adjusted for my taxes. And the HOA fees. You got to adjust for these things. I'm telling you how to do these deals. Now, I bought this deal from a group while there were other more sophisticated and wealthier individuals and companies trying to buy this deal, okay? My NOI will be $6.8 million. I think my cash on cash is going to be 8.26% in year one. I'm going to take a point of that to manage it, and I'm going to distribute 7.26 to my investors. Okay, and this is how the deal works. 6.8, my debt on this deal, I think my debt's going to be 99 million. I already got the loan, so I don't need your help. Okay, 99 million times, if I'm not wrong, my interest rate on this deal is going to be, I think Ryan put it in here for me. I think my interest rate's going to be 3.62, but I'm going to go a little higher because the Treasury, I haven't locked on my rate, so I'm going to go 3.7, 0.037. Okay, my debt on this deal is going to be $3,663,000. That's million. That's my finance expense. Okay, you're like, oh, $1 million is so much money. Dude, my debt will be $3.6 million a year. Okay, now why is that important? Look, you want massive deals. I'm telling you, when you play this game, when you start playing the apartment game, nobody wants fewer units. You want more units. This is 531 units. I could have 53 vacant and still have a 90% occupancy and cash flow the property. Your deals aren't even this big. Your deals aren't even 53 units. My vacancy will be 53, okay? Probably less than that. We'll probably be at 94. What are we at right now, Ryan?
94%.
We're at 94% right now. So I have about 31 units vacant right now, okay? Bigger than your smallest deal. Okay, so check it out. Okay, we're gonna have 3.2 million, 3.1 million, 37,000 cash flow. I paid the debt, I paid the expenses, I paid the lost leases, the concessions, tenants, termites, toilets, fixed all kind of dumb shit. Roofs are fixed, paint's fixed, rehab the place. Oh, and I have 2 million. Let me just see, how much do we have for rehab, Ryan? Rehab costs $2 million in this deal, okay? I have all my closing fees, my legal, I handled all that. I bought the deal. How long did we negotiate this transaction? 3 weeks, 4 weeks? 3 or 4 weeks. I'm the one that flew up to Maryland to get the deal, heard about the deal, called the guy, said, I'll be there tomorrow morning. He's like, man, I'll be there tomorrow morning, bro, okay? Like, I went there with a lot of urgency. So this deal, $3.1 million, 3.1, how much did we put down? 3.137, and I put down 41 million. When did we close this deal? This month?
We closed it December 19th. Our close will be December 15th. Pre-close.
Okay, 7.6% cash on cash. You're like, wow, that's pretty good cash on cash. No, it's a great cash on cash. Don't kid yourself. If you don't think that's a great cash on cash, you do not understand the marketplace. I had a really famous guy the other day ask me, what cap rate you buying that at? Like a 6? I'm like, dude, you don't know the market anymore. Don't embarrass yourself. You're going to embarrass yourself saying these things in public, okay? So I'm going to take a point of that. I'm going to take 1 point of this, okay, to manage the property, and we're going to pay our investors out 6%. Now I'm going to show you how I'm going to increase that here in a second. 0.066 times 41 million. If anybody comes in, any of our investors come in, Every deal we've done so far has been oversubscribed. Next year, we will pay out $2,740,000 to our investors. $2,704,000 to our investors on this one transaction. If one person came in with me and put the whole, man, I'm having a bad hair day, huh, guys? Bad hair day, but a great real estate day, because I got this deal. And I wanted you to know about it before anybody else did. Now, I'm going to show you a little trick here. This is called forced appreciation. There's a term called forced appreciation, and there's also a term called normal appreciation. There's also a term where that's often used, value add, meaning I'm going to go fix something. In this case, we're not going to fix anything, but we think there is a value add. Okay, this is a missed value add. The last owner, because the last owner was there 15 years, I believe, and one of the things we look for in real estate is people that have owned properties for 14 and 15 years. It's a cost basis. Their cost basis is so low, that they don't need to increase the rents. And because of that, you'll have a property that is under rented. The rents on this property are $1,800. Every unit's been fixed. Every unit has been rehabbed. You're like, where's the value add if every unit's been rehabbed? Because the previous owner's cost basis is so low, and the expectations they promise their investors is so low that they don't have to raise the rents. Okay, we think these rents are more in line with $2,050. I'm just going to round it off to $2,000. Okay, and I'm going to assume that over the next 3 years, we're going to get another $200 of rent per month. And we're going to do that on 90% of the units. Over time, it won't be overnight, it'll be over time, times 531 units, times, now watch how fast things start scaling here. Okay, 200 times 531 times 0.90, not all of them, times 12 is 1,146,960 of new income. Now you're like, okay, what does that have to do with anything? Does that mean we make another $1 million? Well, no, not really. What it means is this: if I can keep 50% of that, because there's going to be expenses, some expenses on collecting that money. Some people would say there'd be expenses. I could also say to you, no, there won't be any expenses on it. But I'll take the 50%. I can operate this thing at a 50%, probably closer to 45% expenses, leaving me with 55% of this number. But I could make an argument that I could keep 100% of this because I'm already spending about $5 million a year to manage this property. Me raising the rents $200 is not more expensive to run the property. But let's do it both ways. This number right here, this new cash flow, this is new cash flow. Or new NOI, okay? If I keep 55% of it times 0.55 equals 630,000 divided by 0.05 equals $12 million of new value in the property that I could sell the property for right now today if I could get that $200. So if I could magically go in there and by the end of December raise all the rents $200, I can't, won't happen. It's going to take time, but if I could go back to the marketplace and say I'd sell this deal for $12 million more, and somebody'd be like, yeah, they would pay me the same return I paid to buy it, and they'd say, let's do the deal, okay? But I'm going to show you what I think it really will do. Most people would be happy with the 114. I'm sorry, most people would be happy with the 12 million, not me. I think there's $22 million. How much did I put down? 40 million. Put down 40 million. 40 million would become $63 million. I would make 50% on my down payment plus my cash flow. That's if the rents are under market right now. What if the rents go up another $200 over the next 3 years? And then another $200 3 years from now? What if the rents are $500 a month higher? I think there's 200 right now without time. But what if in the year, let's say 6 years, 2026, the rents are $500 higher? Can you do the math? Times 90%, because I can't collect it on all of them. Okay? What's the new NOI? And what is the new value increased if you can keep? Okay, I'm going to give $10,000 to anybody that can, no. I'm going to give $1,000 investment in Cardone Capital, $1,000 prize to anybody at Cardone Capital that can figure out the new value of the company if it's 5.25 cap rate. 5.25 cap rate with a new NOI based on a 55% expense. I don't think anybody's going to get this to NOI value. You're like, man, shit, I don't know what I'm having. I can't even apply for it. Just try it, man. Try it. See if you can figure it out. I get another $500 times 531, 90%. What's my new NOI? What would be my new value at a 5.25% cap rate? And you got to answer this question. What would the new cash flow be to the next buyer? Because if you don't know that, you don't know your exit. And if you don't know your exit, you can't get out. Okay, I was in Dubai and people were like, we can get 8% here. I said, yeah, you can't get out of the property though, bro. He's like, what? I said, there's no exit. Okay, you go to North Dakota. I can go to North Dakota right now and buy stuff and get 10 and 11% cash flow. There's no exit. When you exit, you will not get any money for the property. Yeah, you can earn 10 and 11, 12% on some of the properties. They're brand new, North Dakota. It's all about the fracking and the new jobs. There's towns being put up, apartment buildings being popped up. They will literally be 100% vacant in the next 10 years. They won't exist, okay? You could probably get 10 or 11% in some urban city, Detroit, okay? Where you got 90%, if you get 90% occupied, then you're doing great. You can go find some place in some part of the world where jobs are going away and there's more risk. Guess what? The cash flow will increase, but your exit will kill you. You want to be able to get your money back. Real estate is beautiful because of a number of things. Number one, and these are the things you don't want to disregard with real estate. Number one, cash flow. Number one, capital protection. Okay, Warren Buffett says don't lose money. Number one, multifamily apartment buildings. Wall Street Journal picked up the article this weekend. Last week at CNBC. 2 weeks ago, I was on Yahoo talking about houses are not investments because they don't provide you with cash flow. There's a family that sold their house so they could travel. Okay? Wall Street Journal this weekend, Saturday, wrote, people have stress taking care of their homes. They have more stress than people that rent apartments and don't have the stress of having to take care of the house. Number one, capital protection. You got your money sitting in a house right now. There's no capital protection. Okay? What if you can't sell your house? What if 21 million, there was another article CNBC did, 21 million homes, if 21 million homes in America got sold, 21 million homes showed up. If 21 million people died, 21 older people, they're 60, 65, 70 years old, 21 million people died this weekend. Okay, they're old people. What are they going to do? All those homes are going to go on the market. They're going to flood the market with homes, and nobody's going to care about what the price is. You don't protect your capital like that. You only protect your capital when you have a combination of these things. Number two is cash flow. If it don't cash flow, you're not protected. Look at these companies that don't have cash flow. Uber has no cash flow. Okay, one day maybe they make it and you're going to make a bunch of money. But until then, you are speculating at best. Number one, capital protection. Number two, cash flow. See, Apple stock has massive cash flow. Massive cash flow. Their iTunes alone has massive cash flow. Positive, by the way. Netflix does not have cash flow. They're still negative. They got a lot of people. They got a great future in front of them. They got tremendous competition. Everybody's coming after them. Disney would be a better bet than Netflix.
Yeah, Mickey Mouse.
Mickey been giving cash flow for what? Hey, by the way, if you're in an IRA, you got an IRA, a 401k, text 305-407-0276. If you have an IRA or a 401k or a retirement account that you can self-direct, 305-407-0276, and we'll help you analyze whether or not you could do this. Use Cardone Capital to get capital protection, cash flow, and depreciation. Why do you want depreciation? Because depreciation on real estate is the best way to bang up the IRS. If you hate the IRS, please post in comments, I hate the IRS. You don't even like me. But let's face it, you like me less or more than the IR and the S. The GC is still a better friend to you than the IR and the S. Depreciation, okay? The $2.7 million that we distribute to investors next year, these people will probably claim a $3.2 million loss for the income that they received against their tax return and offset their taxes. That means on the $2.7 million, if I gave all this money to Johnny, let's say Johnny earns $100,000 at his job, and he earns $2.7 million from me, he would pay less taxes on me sending him $2 million than he would pay on the $100,000 he earned. How sick can you get? Bleh! Now's the time to throw up, okay? Four, appreciation. If you would have bought real estate, apartments like I'm buying right now, if you would have bought in Florida 10 years ago, your money would have doubled already. If you'd have bought 10 years before that, it would have doubled again. If you'd have bought 10 years before that, it would have doubled 3 times already. That means you'd have a 2x, a 4x, and a 6x return on your down payment. But the truth is you would probably be an infinite return because you would have refinanced the property. One of our goals at this property is to put $40 million down, finance $100 million. I'm rounding off now. This is actually $99 million. I'm rounding off. Our goal is to actually get this property to be worth about $200 million, go back to the banks, finance 150 of it, return all the $40 million to our investors. Oops. So bad. Started out as a great product, didn't it?
Yeah.
Bought it for $140, finance $100 million. We're going to go back to the debt market. Even at 180, 75% of 180 is what? That's our target, 180 times 0.75, 135, okay? We would pay off the 100, get a new loan on the deal for 155. Is that right, 145? We get a new loan for 145 and return, we got $35 million left over, return 35 of the 40 million, pay everybody back the 40 million, we would only have $5 million left in the deal. We would control a $180 million asset with $5 million, okay? Now, what we could do is if I could get closer to the 190 or 200 mark, let me just see if I can do the $500 increase, 500 times 531, to answer that question earlier. Remember the earlier question? 500 times 531 times 12 times 0.94. It's $3 million divided by 0.05 equals 59,896,000. So what did I pay for the deal? 140 plus 59 million. That's 199 million. If the banks would give me a 75% loan on that amount, equals $149 million. I owe 100. Check this out. I paid the investors back 49 million. We put $40 million down to buy the deal. Okay, this is how I score. I take that $49 million left over. This is a new deal. This is called a refi. This is better than selling anything. This is an exit without an exit. This is total right here to the IR and the S, okay? This is the ultimate play in real estate, is we would refinance the property over here because of the new values, because I got the NOI, $500 a unit, okay? I would refinance this property. It could be 4 years, 5 years, 6 years, 7 years. It could take me 8 years. I don't really care. This is our exit. This is our ultimate exit without an exit to the IR and the S, okay? That middle finger's for the IRS, okay? Okay, this is the I, that's the R, that's the S. I'm just gonna, okay, so watch. I'm gonna refinance this thing. I got a new value of 199 million. I paid 140 plus the $59 million of natural appreciation. Just happened over time, okay? Gradual rent increases. I got a new value of 199. I go back to my debt markets and say, hey, I wanna pay my loan off. I got 3 years left on it. I wanna pay it off early. I want you just to get me off this loan, get me another loan, okay? Or I'll wait 3 years and pay it off. I owe $100 million right now. And they're like, yeah, we can give you $149 million of new debt on this deal. You owe 100. Okay, good. I pay this loan off. I got to pay these boys off. They're like, you got $49 million left over at closing. Good. Take the $49 million, send 40 of it to my peeps, pay them off. Everybody's got their money back. $9 million, I'm keeping that. That's where I score. Your boy Uncle G. I'm keeping the $9 million. Now I got another gift for you. Okay? We all own the property. We own the property. You understand what I'm saying? We own the property. Okay? 531 units. We got a new NOI. We got a new NOI let's see, what do we say here? We got a new NOI. I'm assuming the same NOI. In fact, I'm going to back it up a little bit just to be even more conservative. Nothing wrong with being conservative. Say it's a 5 cap. We got a new NOI, 200 million is the new price. I'm rounding up. Times 0.05. Check it out. I got an NOI of 36. It's not letting me do it. 10 million. $10 million NOI. Should be on my sheet right here, actually. This is what a packet looks like on a property. So I'm going to go in here to year 10. Should have, yeah, there's financial analysis. If you want to look at this, you can call my office. I don't know if it's going to have the 10-year in here, actually. There's 10 years. Year 10, my new NOI. They say 9.155 million. Let's just assume for conversation, yeah. No. 105, yeah. Yeah, 9.15 million. Let me see what that looks like. 9155 divided by 0.05 equals $183 million value. Let me see if that would get me there, times 0.75. That almost gets me there. Even at the lower number, even the lower number gets me within $3 million of paying off my peeps. But check it out. Let's say I got $10 million of NOI now, my new debt. Because this is how you got to figure your exit out. If you can't figure all this out in the future, you shouldn't be buying real estate. $147 million. Is that our new loan amount? 149 million. 149. Now, I'm going to make an assumption now. I don't know if this is true. I'm going to make an assumption that the interest rates are where they are right now. Don't know that to be true. I might even go up a little bit, but they're going to be less. 5,960,000. Now watch this, folks, okay? This is where this is going to be freaking ridiculous. If you haven't subscribed to the channel, come on. What's wrong with you? This is stupid, okay? I'm going to show you how to make sick money. This is how the wealthy make money. The distribution to the investors will be $4 million per year. What is their investment in the property? Zero. They own a $180 million to a $200 million asset. This is how the rich get rich, folks. Okay? This ain't about Democrats and Republicans. This is the rule of the way of the world. It's called compound interest. This is what Warren Buffett called the eighth wonder of the world. And if you don't know compound interest, if you're not earning it, then guess what? You're paying it. And you're going to get beat up. You and your family are going to get beat up for the rest of your lives if you don't learn this game. You can't do this game getting good at work. Okay, getting good at your job, getting good at video, getting good at graphics, getting good at whatever the hell you do is one thing. Earning money that compounds, okay, where you compound values, not just interest, but you're compounding values. In this case, we're compounding rental income over time. These people, these investors right here, not workers. These are not workers. These are investors. These are not managers of real estate. These aren't landlords. These are investors of real estate. You do not have to run the property to get rich. Jared Glant, Ryan Secco, Sherry, Elena, my kids are going to get rich investing in real estate. I have Joe Lane and his wife got, I think, $60,000 last month in rental income. For me, they don't own the property. They've never even been to the property. So watch, $4 million will be returned to the investors on a monthly, on an annual basis, 400 grand a month. I'm sorry, $360,000 a month will be distributed to these investors in year 8, year 9, year 10. If we start at 10, it'll be 11, 12, 13, 14, 15, 16, 17. What's the return now? Into the land of like, I don't even know what the return is. I have no money in, but I'm still getting a check every month. Okay. My name is Grant Cardone. This is real estate investing made simple. It's the Cardone Zone. This is our newest deal right here. All the examples I've given you is on this deal. All the examples I've given you, by the way, today. Look, I'm just telling you what I think it's going to do. Can't promise you it's going to do that. You know that. You know I can't promise anything. Investing requires a risk. Not investing guarantees you. Okay, the banks are going to kill you. You're not getting paid by the banks, folks. Okay, 0.012%. 1/8 of 1% is what the bank pays you. An 8 ball. You got to get your money invested. You're working too hard. You're working 40% of the year, you're working for the government. The other 60% of the time you work for yourself. You better get that 60% growing. Compound interest, the 8th wonder of the world. In this case, it's not compound interest. It's the compound effect of rent increases that actually distribute to the investors. And by doing so, they increase the value of the property over time. Do your research, do your homework, get your money invested in real estate that has rental income behind it in good locations where jobs support it. We're in between, in this property, Baltimore and Washington, D.C. Okay, you go north from D.C. and you go this way to Baltimore. You're like literally trapped in one of the most expensive counties in the United States of America, where properties around it are $1 million properties. We got a college next door to us, Whole Foods next door to us, and $1 million homes with some jobs provided by, what's the black ops people, the CIA and all that? Dude, they don't even tell us how many jobs they have. It's all undisclosed. Okay, thanks for watching. Please comment below if you enjoyed the show, if you got something out of it. What'd you learn? Oh, by the way, what did I say? What math did I give you that was wrong in the show today? And who wants to win that $1,000 to figure out that calculation on the value of the property? And don't use my numbers to get there.